Hello, this is Quanray Invest. Today I'll be talking about three high quality stocks that I bought in the past week or so. So the market is up quite big today. It's up around 1.5%. We're about to close above the 200-day moving average. And overall, I think this is bullish for the stock market. We are likely going to test all these different moving averages as well and then break all-time highs, hopefully. But anyway, so let's talk about three of the companies that I bought over the past week. So the first company that I bought is actually Amazon. So Amazon is currently trading at a 35 times earnings, 30 forward earnings. And if you were to look at the historical valuation for Amazon, it is currently trading at one of its lowest points in its history. So in fact, I think it is trading at its lowest point. So let's talk about Amazon over here, its tailwinds. The first tailwind is simply just the operating margin of everything else outside of AWS increasing. So if you were to look over here, this is Amazon's margins for everything else outside of AWS. So in 2023, it was around 2.5%. In 2024, it went up to around a 5.4%. So I expect them to continue increasing it over time. And if it increases to around a 7% margins, then Amazon is easily a $220 stock already, 10% up from the current price today. So I think for Amazon over here, the margin story is still going, it's going strong. And if you're to look at just some numbers over here, so this is Amazon's operating margin by segment. So if you're to look at the advertising segment, it's around a 15% right now. So if you're to just look at Google and Meta's operating margin, Google is around a 32%, sorry. So Google has all the other businesses as well, some of them losing money and all that, and it is still able to have an operating margin of around 32%. Meta's one is at around a 48%. And so if you're to just change Amazon's operating margin for the subscription business to around a 35%, which is what I did over here, Amazon is a $233 stock already. So I think for Amazon over here, it is an extremely simple story. It's just a story of some margin expansion over time, especially if they increase their efficiency and increase their profitability, which is what they've been doing over the past few years since Jeff Bezos stepped down. So let's look at some of the possible headwinds for Amazon over here. So the first one is just an economic slowdown. So if there's an economic slowdown, then obviously Amazon's business is going to be hit quite hard because it relies on consumer spending. So when your economic conditions become a bit weaker, then consumer spending drops, then of course Amazon's business will take a hit as well. But this one is a bit, I mean, most companies suffer during an economic slowdown, so it's not really a problem to own a company that is prone to economic slowdowns. So the only companies that will benefit are your consumer staple companies. I don't see any other companies that are able to sort of like continue growing and growing, especially in an economic slowdown if there's a serious one coming. Next one is the high capex. So Amazon is projected to have around $100 billion in capex this year. They did around $80 billion last year. And so for me, I think the capex has one big issue, which is the capex could lead to a lot of depreciation over the next few years. Because for all your capex, all your different data centers, they usually last around 5 years. So if you just take the $100 billion spent this year and then the $80 billion spent last year, if you have to just spread it out over the next 5 years, that's around a $30 billion that is being burnt every single year through the depreciation and amortization. So I don't think that capex is a problem right now. Why? Because if you have to just look at Amazon's ROIC, this is Amazon's ROIC. Their ROIC went from around 8% to 17% from 2023 to 2024. So when it comes to companies with high reinvestment rate, meaning high capex, high R&D spending, you normally want them to be able to generate returns. So if they spend a lot of capex, you want them to generate returns as well, which is what Amazon is doing already. So you can clearly see that there is an ROIC expansion. So when there's ROIC expansion, that means that they are able to return the high capex that is being reinvested into the business. And so I don't think it is a problem for now. Maybe it's a problem for next time, but for now, I think it's bullish for Amazon. And I don't think the high capex is a very big issue now, especially when your AWS is running out of it's basically over demanded. There's not enough supply for it. So Amazon is a quality business. It is one that I bought in the past 1 month or so when we had a market slowdown and the market drop. And I continue remaining bullish for Amazon. Hopefully it drops a lot more to around $170 as well as $140. Those will be my two buy entries. So for me, I think Amazon is still one of the highest quality businesses out there. It is one of the widest moats ones. You have your AWS portion, it's a market leader in the cloud computing sector and it is unbreakable. You have your Amazon retail and online stores, which cannot be replaced by AI as well. So if you to just compare this with enterprise software, like for example, Salesforce, Adobe, all these companies, they could be taken over by AI one day. So Adobe, for example, you have generative AI, and then Salesforce, you have all your different agents that could take over Salesforce market share. So, but if you're to compare this to Amazon's business, you have literal retail stores and online stores as well. Those cannot be taken over by AI. The only way AI can get involved in this is to help improve the profitability and the margins for this segment, and that's why I remain bullish on Amazon today. Next stock that I'll be talking about is S&P Global. So S&P Global has mainly three business models. You have your ratings business, you have your data business, as well as your indices business. So your indices business, it is the S&P 500 and then the Dow Jones. This business is extremely incredible. All they do is just they license out their index and then they collect a royalty. And then your data business, they recently did an acquisition back in 2022. It was IHS Markit. And this data business is actually growing at around 10% every single year in terms of revenue. They have all the different portions. You have your commodity insights, your mobility, as well as your market intelligence. All of them hold around 20% market share in its individual segment. So it's not incredibly monopolistic, but it is a stable, growing business. Then the last portion is the ratings business. So the ratings business, it holds a duopoly with Moody's. If a company needs to raise debt, the only way for them to get a lower interest rate is for them to get it rated by S&P Global or Moody's. And they hold a duopoly. And so 45% of the net income comes from ratings, and around 50% of the ratings net income is recurring. So it's around a 22.5%, which is non-recurring, which is dependent on your new issuance. So for S&P Global over here, the valuation is currently at a 40 times price to earnings, a 28 times price to free cash flow. And for me, I think for the business quality, paying a 28 times price to free cash flow is quite reasonable for this company. And the PE is a bit elevated because of the IHS Markit acquisition, which caused sort of like your shares outstanding to increase by a fair bit, and that's why the PE is a lot higher today. So if you to just look at why S&P Global is a high quality business, it has extreme high pricing power. If you to just look at the pricing power over the years, in 2015 they charged around 6.15 basis points for rating a debt, and then in 2022 it was around a 7.15 basis point, and now it is 2021, sorry, it was 7.15, and now it is around a 7.45 basis point. So a basis point is basically 0.01%, and if you to just think about it, $100 million, imagine they just increase it by 1 basis point. That is already easily around $10,000 already. So I think for S&P Global over here, it is incredibly monopolistic. It operates in a duopoly with Moody's. And for S&P Global over here, why is it that everyone needs to get the debt rated by them? It is because they are sort of like a textbook. They are manual for your ratings, and the only way for all these companies to get a lower interest rate is to go and get the debt rated by S&P Global or Moody's. Next one, they're sort of like a toll gate business. So they don't do anything, they don't reinvest, they don't have high capex. All they do is 95% of the free cash flow is just given back to shareholders. You have like 6% that is stock-based comp. And so I think for S&P Global over here, it is an incredible business. It's just secular growth. They're just doing nothing and they're collecting revenue. And that's what I like about this business. And then the data business as well is growing at around 10% every single year, and with improving margins over time as well. So if you just look at the margins of S&P Global pre around 2020 or so, it was at around a 10% operating margin, and now it is at around a 24%. So it's incredible margin expansion as well for this business. So in terms of the quarterly operating margins. So for S&P Global over here, there are mainly there's mainly one tailwind over here, which is the debt wall. The debt wall is projected to go all the way up until 2028, and then it expires in basically a lot of the debt will expire in 2028, and that will be one of the tailwinds for S&P Global in terms of their ratings business. And then there's some secular growth trend for this business as well. So although it's an extremely boring business, you have some tailwinds like your recurring assessments. So whenever you rate a debt, every single year you have to try and like you have to pay S&P Global to like go and take a look at your debt, and then take a look at all your different new debts that you raise as well, to rate them as well. So another portion is your emerging market and international credit market. So the credit market has been increasing over time. We have gone from around $8 trillion in 2008 to now around 2025 $30 trillion business. So I think for S&P Global over here, it is an extremely it's a company that is able to ride on this secular growth trend. And then you have the last portion over here, which is your China regulatory approval. So in 2020, China actually approved of S&P Global ratings. And although they are still restricted in terms of the government, that is another possible growth trend and growth direction that S&P Global could expand into. As for your headwinds, simple. It's just interest rates and then the high valuation. So although S&P Global now is around 28 times price to free cash flow, some people still think that it's a high valuation. But for me, I think it is better to pay up for quality than to settle for a cheap 12p business like Ford, for example, or AT&T. So next one, interest rate. So for the interest rate environment, if interest rate were to rise, then obviously your debt issuance will come down, and that could be a headwind for S&P Global as well. But if you're to just look at Trump's policies, if you're to just listen to what the Fed is saying, I'm not trying to bet on the macroeconomic conditions, but consensus is that the interest rates will come down. And if the interest rate were to go up, then the markets are going to crash like 50, 60% for sure. But interest rate is not actually a problem for S&P Global. Why? Because they're just a toll gate business. Because if your interest rate go up, okay, debt issuance will drop. But these people that need the debt, they will still have to raise the debt someday after that. So maybe they'll just raise it 2 years later. But during the 2 years lifespan, when they don't raise the debt, S&P Global can actually just increase their prices. And then when they have to come back, they have to pay a higher price for the debt that they initially wanted as well. So for S&P Global, I don't think interest rate is a very big problem. Maybe the stock could drop another 30% or so. If it drops 30%, I'll buy the dip. It doesn't matter. So yeah, S&P Global is a quality business. It is one that you should look into as well. Last one is Google. So Google's valuation over here is 20 times earnings and 18 times forward earnings. So if you to just look at the S&P 500 as a whole, S&P 500 is trading at around 26 times earnings. Google is trading at 20 times earnings. So it is a quality business that is trading at a discount to the overall markets. I don't think that's justified, and it is trading at a less than 20 forward earnings. It is incredibly cheap for this company. So if you to just look at the business model as a whole, Google search is around 50% of the revenue. You have your network and subscription, which is around 20% of the revenue. So the network and subscription consists of your YouTube TV, your YouTube subscription, your Play Store, and your Google Drive subscription as well. So those portions are recurring revenue business models. It has been growing quite steadily as well. So I don't think it's a very big problem for Google to have around 20% of the revenue from this portion. And then you have Google YouTube AdSense, which is around 15% revenue. So I think Google YouTube is an extremely underrated business. There's no innovation risk. It's not like Netflix where you have to continually go and make new content. All you need to do is just rely on creators like this to go and create content and then pay them AdSense, and then they just take 55%, I think 50% for just providing a platform for all these creators. And then you have the last portion over here, which is the Google Cloud GCP. So your Google Cloud platforms is around 12% of the revenue right now, and it is growing at around 30% year on year. So if you're to just look at tailwinds for Google Cloud and Google YouTube are taking up more revenue. That's a very good tailwind for this business, because I want this Google business to diversify out of search. So search is still currently around 54% of the total revenue, and I expect them to basically diversify out of search into other revenue streams. So for example, your Google Cloud, your Google YouTube, Google subscription, taking a larger chunk of the total revenue. And then the other portion, the other tailwind, is that Google search is able to hold its monopoly. I'm not sure how strong this tailwind is, but hopefully they can. They've been doing so over the past few years already, even with competition from Meta, from Amazon as well. And so I expect them to continue doing so, even though there's all these different LLMs coming up as well. Last one, Google's last tailwind is simply just the valuation. So you have a company, a Mac 7 company that is trading at 20 times earnings. I think Google's fair value is at around 25 times, 26 times earnings, similar to what Meta is trading at. So I think 20 times earning it's a very deep discount as compared to all the different companies and compared to its historical averages. And that's why I've been buying Google. So for your headwinds over here, Google search will lose revenue. I don't think they'll lose revenue. Maybe they'll lose some market share to your LLMs. But are you really searching for a restaurant on your LLMs? I doubt it, right? So your LLMs are normally for research purposes only for now. For Google search, the way they monetize it, the way they get the most revenue is when people search for like restaurants or for like services things instead of all your research stuff. So your research stuff, they normally generate less revenue for Google because there's no company that's advertising all this research stuff. But for consumer products like food, for example, those portions are the ones that make Google the most money, your travel as well, because they have advertisers, they have like companies paying for advertising in all these different segments. So I think the LLM argument is a bit flawed because everyone is saying that the LLMs will basically take over Google's market share. Next portion over here, the other headwind is the capex cycle. So like what I talked about for Amazon earlier, the ROIC for Google is still extremely high. So I think there is still a high return in terms of the capex. And as long as they can hold the ROIC at this rate, I don't think it's a red flag for this company. Last portion is just their poor management and acquisition cost. So they recently just bought a company called Wiz for $32 billion, and they paid around a 64 price to sales for this company. So if you're to just look at things from a broader perspective, I think they overpaid for it for sure. Because although this company is growing at 100%, paying a price to sales of around 64 times is just crazy for this company. The company over here, Wiz, what they do is they're basically a multi-cloud cybersecurity company. So they're a company that can integrate your AWS, your GCP, and Azure into one singular platform and one cybersecurity platform, and that's basically their competitive advantage compared to its peers. So that's the competitive advantage that they have compared to its peers. And so I think for a Wiz over here, if they get acquired by Google, then the growth will definitely be stunted. I'm not too sure why Google's management did that. They could spend this $32 billion on buybacks and dividends, especially when the stock price is currently now trading at one of its lowest points in terms of its valuation as compared to the past few years. So this one over here, I've looked into it. I'm a bit skeptical of the deal, but it is not strong enough for me to sell the company now, especially with this valuation. Maybe when it reach around $200, $210, then that will be when I consider selling. But for now, I think Google remains extremely undervalued. So this is why I'm still bullish on Google. Google is not the highest quality business out there. There's high reinvestment, probably poor capital allocation as well with their recent acquisition. But this business is one that we cannot live without. So imagine just one day where we have no longer have YouTube, no longer have Google Drive, no longer have Google Maps, for example, or Google Search. I think it'll be basically a miserable day for all of us. And I don't see a world where we don't have Google YouTube in 10 years from now. And so Google could be a textbook of a company that has a declining mode, but for now I remain bullish on this company, simply because of its valuation, and I believe the Google search and LLM situation is getting a bit overstated, meaning to say I don't think LLMs will actually take a lot of their market share away. And so this is one I'm heavily invested in. I have around 10% of my portfolio invested in this company already. Hopefully it goes down to around $140. That will be when I get my full allocation. But for now, I remain bullish on Google. So let's talk about this last portion over here, which is stocks that I've considered. So the first stock that I've considered is Adobe. So Adobe is currently trading at one of its it is trading at its historical lowest valuation as compared to its past. It is a business that has extremely high pricing power. So I look at Adobe's prices over the past 5 years or so, and every single year they basically increase prices at an average of around 8 to 10%. So that is incredible pricing power. But if you were to just look at Adobe's revenue now is currently growing at around 10%, which means that the volume is not increasing anymore. I'm a user of Adobe. I like Adobe software. I like their editing software, their PDF editing software as well. But for me, I think Adobe, it is a company that is facing too much competition. So I've been using Canva a lot as well, and I think those people that are not in the corporate division, they will use Canva as well. And that's the problem for Adobe, because for Adobe, you have to pay for it, whereas for Canva, it's free. So I think Adobe over here, it is a company that is not helped by AI as well. So you have your Gen AI, which could disrupt Adobe's basically their mode, because your Gen AI will be able to create images, create all your different videos, which are basically what you do on Adobe as well. But Adobe, you have to pay for all your Gen AIs. You don't have to pay. So that's why I haven't bought into Adobe. It is currently trading at a decent price, I would say, but I always find myself comparing it to Google, and that's why I haven't bought into it yet. Next one is Uber. So Uber is one company that I've been asked a lot about as well. So for me, I think Uber, the problem is Uber's high valuation, number one, and then the second one is disruption risk. So I do see a world where we go into all your different automotive vehicles. I mean, Waymo is already doing 200,000 trips every single day and so on already. So um, Uber is a company that has real disruption risk, and it is a mistake for them to stop their automotive fleet because, of course, people can use Uber software next time. But if there's no longer any drivers, no longer any need for real drivers, I don't see the need for people to use Uber software. They could just create their own software. So, for example, like Waymo creating their own software, Tesla could easily create their own software, and with Elon Musk influence over all these people, I'm sure he'll be able to create a software that is much more superior as compared to Uber. Of course, Uber has all your data in terms of matching prices with demand and all that. But I think Uber is currently a company that's facing a lot of disruption risk. Of course, the robo-taxi thing could be overstated, but if let's say robo-taxis come in 10 years, maybe I can hold Uber for 10 years or so. But I don't want to have the concern of buying a company and then thinking about this disruption risk every single day while owning it. And another portion is Uber's high valuation. So if you to just look into their cash flow statement, they have this one portion over here, which is the insurance portion. Basically, what they do is they collect money as insurance fees, and they basically maintain it as a float. So they can use the money, but they eventually have to pay it back. It's not real cash flow from operations. And then the other portion is the high stock-based comp. So if you to just remove those two portions, Uber is currently trading at a to free cash flow of around 40 to 50 times, which is not what I like in terms of the valuation. Of course, it's growing 20-30%, but 40 to 50 times price to free cash flow is crazy for a company that has disruption risk. Last one is Nike. Nike is a company that I've considered as well. It is a company that's an incredibly strong brand. So Nike, you have your Jordans, you have your Nike, and Bill Ackman actually bought into Nike as well not too long back. So I think Nike, the problem with the business is just I don't understand what's going on with the business. Like, how is this company losing revenue at around basically dropping 10% in terms of the revenue, and then having earnings drop at an even faster rate as well. And I think Nike is currently still overvalued. I think the fair value for Nike, based on my calculations, is around $50. That would be a possible consideration for Nike. For now, I think Nike is not a buy for me, especially in the fashion division, because Nike and Adidas, they used to be a duopoly, and they somehow turned it into an oligopoly where you have all your different other competitors as well. So you have your Hoka, you have Skechers, your Crocs, and all that. So I think Nike over here is a company that is facing too much competition. Simple as that. You have your other Chinese companies as well, like your Anta, your Li-Ning. All those are taking market share from Nike, and that's why I don't invest in Nike, and I'm not planning to until maybe it reaches an extremely undervalued price. Thank you all for watching. Hopefully you found this useful, and yeah, leave me some comments.